I know. It's a two for one tonight, y'all. So last week I recorded this info stream about the three basic financial statements, and it was very choppy, so I had to take it down. I am not looking for a lot of people to tune in tonight because this information was already covered. I added another slide or two just to freshen it up a little bit. But if you watched this last week, this is pretty much the same information. I just wanted to make sure I had a better video for the people who didn't. And if you watch through all the choppiness, I sincerely apologize. I guess it was like a Wi Fi issue or something. So forgive me and forgive Xfinity. So today we are covering the three basic financial statements. Those financial statements are the income statement, the balance sheet, and a statement of cash flows. And you will see how they all intertwine. This all goes together. You do not have to be an accountant to understand these financial statements. I am going to break them down to as simple as forms as I can because I hate when people over explain things like this because this is not something that a layman really cares about. Like we not even paying this that much attention. So let me set this up a little bit. Set this up. Let's just get to the money. Let's get to the money. A quick introduction of myself. I am Alvin C. Hill the fourth. A lot of people call me Jackpot or JP1 for short. It's basically the same name. Alvin and JP1 is the same. Jackpot is the same as JP1. My family called me Little Man. It's all good. It doesn't really affect me either way, as long as you're not calling me crazy. I am the CEO of Real Life Business Solutions LLC, and that also goes by Real Life Credit Solutions. If you see one or the other is interchangeable. I try to keep it separate for marketing reasons. If I'm doing a credit ebook, I try to put the Real Life Credit Solutions. If I'm sending you something from my credit company, it usually comes Real Life Credit Solutions. You may get a a request for money from Real Life Business Solutions. It's all the same company. It's just a DBA. So I have that company, and then I have Gifted and Talented LLC. You see the G and T shirt. That is my entertainment company, and I love it. So I'll never stop doing entertainment. I love doing this too, but entertainment is where I made my bones at. So we got more things coming up, new everything coming out. I currently have a business administration degree and a paralegal certificate. Um, I'm a senior at Wayne State University's Mike Illich School of Business. I'll be graduating in May, and I'll leave that for later. We'll celebrate the rest of that later. Um, I have my business management degree, business administration, business management. It's a little different. Administration is cool, but management actually teaches you how to deal with people. Administration is actually more about paperwork and different things like that. So it's interchangeable to some degree, but it's a little different. So I'm going to get a business management degree. I've seen the best of times and the worst of times, but I thrive. If you know my history, you know I've seen everything from all kind of incarcerations to uh, losses and different things. Uh, I've been through the ringer, and life does not care. So that's what I'm all about. I'm all about telling all my people that you can do better. It doesn't matter what you're doing, you can do better. It doesn't matter what you end up how you started off, you can end up in a better position. My contact information, my business number is 313-883-9664. My business email is jackpot at reallifebusinesssolutions.com. Listen, my phone go off all day, like all day. Like it's crazy. Work so hard that one day your signature will be called an audited financial statement. If you've ever been audited, you understand the process is tedious. It's a tedious process. So if your signature is an audited financial statement, that means you are solid, stamped, signed, sealed, delivered. So, what we will cover in the next 20 minutes to 30 minutes will be the income statement, the balance sheet, the statement of cash flows, the components of each statement, the importance of each statement, how each statement relates to each other, the financial statements and business plans, how they interact with each other, and financial statements and investors. Why are these statements important to investors? The major objectives is to discuss these three financial statements, discuss the income statement, discuss the balance sheet, and discuss the statement of cash flows. Let's get into the income statement. This records funds coming in and out of the company over a certain period of time. So that period of time varies. That period of time can be 1 quarter, which is 3 months. That period of time could be 1 year. That period of time could actually be a month. It depends on the company and whether this income statement is for inside the company or outside of the company as far as investors and different things like that. So at the top of the income statement, you have your sales. As you can see, now these sales are in millions, but we're going to talk in layman's terms. Let's just talk 350. So you have $350 in sales. You have your cost of goods sold, which is how much it costs you to actually make those sales. And then you have your gross profit. So if you look at these numbers, you can see that sales minus, when you see those parentheses, that means subtract. So sales minus cost of goods sold gives you your gross profit. In this case, your gross profit is $100. So you have a depreciation expense. Now, depreciation happens to cars, depreciation happens to factories, different things, equipment depreciates. And you need to understand that if these things are depreciating, then they are losing value. But in these things losing value, you do not have to lose money because you can write off depreciation and you can get tax credits for depreciation, and it actually helps you. So you have your depreciation, which is $10. Your taxes on this income is $15. So out of your gross profit, you lose another $25 to depreciation and taxes, which leaves you with your net income. And the total for that is $75. So you have the average common shares outstanding. It's 25 shares outstanding. And then you have your earnings per share, which are $3 per share. So you have dividends declared per common share, which is 0.050. Now, this is in millions. So that is not point 0, is not of a penny. These are in millions. So you have to understand that these numbers would be 50,000 or whatever. So do not equate this to just it being dollars, but we're talking in dollars to simplify this. So sales was how much money was made. Your COGS or COGS, cost of goods sold. How much was spent to make the sales? Gross profit. The difference between sales and cost of goods sold. You have your depreciation expense. That's your loss of revenue on assets. Once again, things depreciate, cars depreciate, machinery depreciates, your building may depreciate. Taxes on income. This is the taxes that's paid on the income that you've made. Your net income is the gross profits minus your depreciation and your taxes. Your earnings per share is how much one share of this company is worth. That is one of the key indicators of whether you are making money or not. How much is one share of this company worth? Let's talk about the balance sheet. Now, the balance sheet shows a company's financial position at a certain period, at a certain point in time, not over a certain period of time. So, if you go back, you'll see that the last statement was about over a certain period of time, which I explained. It could be a quarter, it could be a year, it could be 3 years, 5 years, whatever that particular statement says over such and such. The income statement, and it's going to tell you the period of time, so you won't have to guess. This balance sheet will tell you exactly when that certain point of time is that this is accounting for. So within the balance sheet, you have assets and liabilities and owner's equity. The basic the basic accounting equation is that assets equals liabilities plus owner's equity. So this is how you balance your balance sheet is assets should equal total liabilities plus owner's equity. So let's see how this all adds up. Your current assets, which is current assets are assets that are liquidable within 12 months or due within 12 months to you. So cash, your cash on hand, cash is as liquidable as it could be. And these statements go in order of liquidity. So your accounts receivable is your next account in order of liquidity because that's money that's owed to you. You shouldn't have to work for that anymore other than, collecting that money. And then you have your inventory, which is what you already have your hands on, and that could be sold at any time. So those are altogether your total current assets. And then you have long-term assets. Long-term assets are assets that are liquidable after 12 months. That could be your equipment, that could be the buildings. Now you can sell these any day, but these particular assets are not looked at to be sold. They are looked at to be acquired and held for a longer period of time. So your building and your equipment together equal your total long-term assets. So let's talk about liabilities and owner's equity. Current liabilities, once again, these are liabilities that are due within 12 months. You have your accounts payable because you have to pay those accounts within a year. And then you have your short-term debt. And these type of things could be uh, bills, what's due on a lease, anything that's due within the 12 months. These, it could be subscriptions or anything else. You got these short-term debts. These are all your total current assets, and then you have your long-term liabilities, which is your long-term debt, and this could be mortgage, anything like that that's not due within the 12-month period. Even if you're paying it off within 12 months, this wasn't necessarily a 12-month agreement. So this is a long-term liability. So you have your owner's equity, which is your stock, your additional paid in capital, your retained earnings. So your stock could be $2 because that's what you have in stock as an owner. Your additional paid in capital is what you paid in to become this owner, or that's the equity you have invested in this company. And then you have retained earnings, which are earnings that were made by the company that you're going to keep and that won't be reinvested into the company. So now you have your total shareholders equity, which is 242. So if you look at the long-term debt plus the total shareholders equity, you end up with 490. It should be $492. Now, when you look at the total assets, you end up with $492. So this balance sheet balances. Current assets can be liquidated within a year. Long-term assets are liquidated after a year. Current liabilities are due within a year. Long-term liabilities are due after a year. Owner's equity is investments by owners. Total shareholders equity is the owner's equity minus the dividends that were paid to shareholders. The statement of cash flows. This reflects a company's financial activity over a period of time. Now we're back to a period of time. This is not at this point. This statement of cash flows covers a certain period of time. Once again, this period of time could be 1 quarter, it could be a full year, it could be 2 years, 3 years, 4 years, whatever. It will say it at the top of the statement for what period of time that this statement covers. So you have three different type of cash flows within this statement. The first one is from operations, the second one is from investing, and the third one is from financing. So let's talk about what finances from operations include. So your net income. Now, if you've seen it at the other statements, your net income is what you get after you pay off everything that you owe and did everything, Bob. You got your cost of goods sold, you took care of that. Now you got your net income. So your depreciation actually counts. Your decrease in receivables because you are losing in you no longer have that money out. That's why it's included in your cash flows. Your increase in inventories, because if you've bought inventory, you probably paid for it, and then you have an increase in accounts payable, less the decrease. So now you have to you this is where math is included. So you got your decrease in receivables less the income. So you got your decrease in the money owed minus the income. You have your increase in accounts payable minus the decrease. So this it shows you was how to equate is more math inside these one line on your cash flow statement. So then you have a net increase or decrease from operations. So this is everything added up. So basically you had 30 and 15, which was 45. I'm looking at the numbers on the side. Your net income was 30, your depreciation was 15. You added those up, and then they subtracted 20 and 10 from the decrease in receivables and the increase in inventories. So now you have 45 minus 30. You didn't have anything in the accounts payable. So you end up with 15 as your net increase or decrease in cases from this operation. So you have this could be millions too. So you have $15 million that you had increase from this operation. That's your operations. And then you have investing. So you purchased equipment for $150 million on here. So it's 150. You are negative now if you don't add the income from financing. So now you have bond issue 100, and then you have an increase in cash, which was 35. So the cash at the beginning of the year was 127. Remember, this is in millions, 127 million, and the cash at the end of the year was 92. If you look at this particular statement, it looks like you lost money, but what you really did was invested in your equipment. You see where it say investing. You lost 150 from investing, but you invested in your equipment and you make money from your equipment. So you're still going to make money. This is just how you look at a cash flow statement. The key components: income from operations, profit realized from a business owned operation, income from investing is profit from long term uses of cash, income from financing is net amount of funding a company generates in a given time period. This measures your financial strength. Your statement of cash flow measures your financial strength. So let's bring it all together. Net earnings from the income statement to the balance sheet and statements of cash flows. If you look at the beginning of this presentation, the net earnings, it flows through to all of these things in one way or another one, and then their current assets and current liabilities on the balance sheet are related to revenues and expenses on the income statement, but you have to make adjustments. These adjustments might be uh, funds that you expected to come that didn't come. They may be some kind of expense that you didn't account for. You have to make these adjustments. So once all three statements are correct, your financial assumptions can be made. You have to make financial assumptions. So let's talk about if you are in a business that is looking for funding or you're looking to acquire some type of partners, then you have to have these financial statements, and they may ask for some other type of statements. These are the basic financial statements. There are a lot more statements, but these financial statements show how healthy your company is. And you have to have these statements and you have to make financial assumptions to show that you can make more money as the years progress or that you can sustain the growth that you've been sustaining over whatever period of time. So that's the importance of actually having these financial statements. You cannot have a fully done business plan without including these financial statements. If you have any questions, I will answer anything that's on the comment section, anything that's in my inbox. I do not shy away from any information. If I do not have the answer, I research and I will get the answer to you in the best way that I can. So that is the end of this info stream. Thank you for listening again. I am sorry that the last one was choppy. Hopefully, this one comes out better. Here is the company information: Real Life Business Solutions LLC, 2785 East Grand Boulevard, Suite 381, Detroit, Michigan, 48211. You can text me or call me at 313-883-9664. That is my business number. Do not contact me for any personal matters with that number. www.reallifebusinesssolutions.com is the website. Once again, thank you for tuning in, and that's real life.